Welcome to the Ken McElroy Show. I'm your host, Danille, here with Ken.
Hey, guys.
So bank failures are going to happen this year for small banks.
Yep, it's already starting. You guys probably know this is all part of the plan, and I just would encourage you guys to stay big picture. You know, sometimes you can – I understand that you want to read all the articles and all that kind of stuff, but the big picture is big banks gobble up small banks, and most of the toxic commercial real estate loans, we can get into residential in a minute, most of the toxic real estate loans are hitting now.
Yes.
And these banks have a credit rating. You guys probably know that, just like you do. You guys we all have a walking credit score, you know what I mean? Banks have the same thing. It's called a CAMEL system, CAMELS, I believe. It stands for capital allocations, asset quality, management, earnings, liquidity, and sensitivity. So each bank has a rating 1 to 5. So one of the things that I think everybody needs to watch is what's going to happen. What bank are you with? And you really need to pay attention to this, because as we start to see these toxic commercial real estate loans make their way through the system, there will be other banks that take over the assets, just like you guys saw with Silicon Valley and Silvergate Bank last year. So that was a little bit different, but it doesn't really matter. You know, you're starting to see these loans come through the system now.
So let's talk about the why, right? Like, why would small banks, some small banks, not make it this year? So you have to really look at a lot of these real estate loans that these banks wrote. Small banks, I believe, write 70% of all
Correct.
Commercial real estate loans.
Small and regional banks are, the big banks that you guys probably all see when you drive around and you see their names on the tops of the buildings. Those are not the banks we're talking about. Those are the banks that are going to take over the assets of these banks. The problem is, it doesn't really matter. It'd be like you taking over a business that had, toxic debt, right? So it's still the same problem. It doesn't mean it's going to go away just because a big bank steps in and gobbles up a small or medium bank. That does not matter. They're going to take a look at the quality of the assets.
Okay, so the first thing that is happening with these commercial loans. So a lot of these commercial loans were good loans. The bank underwrote them. They were great loans with a low interest rate. But as the Fed has upped these loans, the problem that these commercial properties are now having is the rents are performing above the business plan in a lot of cases, but the operations have gotten more expensive and the debt has gotten way more expensive.
This is you guys all know there's 3 components. There's your rent and your expenses, and after that's your net operating income. Then you have your debt, and after that is cash flow. So the cost of debt is going up, and it has gone up. And so, people that are professionals, have been in this industry, they started taking action in 2022. So here we are in 2024, almost 2 years later. So the taps on the shoulder were there 2 years ago. And how were they there? Well, we peaked at inflation at 9.1% in June of 2022. And what did the Fed do? They raised rates 4 times after June of 2022. A total of 2.75%. So they went 3 at 0.75. They did 3/4 point increases 3 times in 2022 and 50 basis points as well. Okay, that really jacked the rates. Okay, so let's call 2022 the denial phase, right? So there's 5 stages of grief, right? So 2022 is the denial stage. 2023 was, I would call that the anger stage. That's the second stage of grief. So the anger stage, and that's when people were running out of money, trying to put all the deals together. Now they're in the third stage, of grief, which is bargaining, and that is where we are today. And then, of course, there's 2 more. There's depression, and then there's acceptance. And so we're in the bargaining stage, heading to depression. That's where we are.
Right. So essentially, when the property is not cash flowing, you are going to be using your reserves to pay that property. And all sponsors have different amounts of reserves, right? But after that, what you're seeing people do last year, where they were getting sponsors to come up with new cash reserves.
Yeah.
So they were either cash calling their investors, or they were bringing in new people.
Right. So imagine. So if you've been in the business a while, you're all over this in 2022. So when your interest costs go up, then your cash flow starts to go down. Just walking through that scenario I just said. So in 2023, that's when people started going out and finding more LPs. They started doing cash calls. They started doing loans. Their rate caps were due. There's a bunch of stuff. And let's don't forget, we're also getting clobbered on insurance rates and property taxes and utilities and labor costs and all those other things. So the one interesting thing about all of this is rents actually were going up during this whole period of time. So that actually gave people like, they've got a little hope, you know what I mean? The rent growth is pretty much all they had to hang on. And now what's happening is we've got almost 1 million new units entering the market. And that's nationwide. Mm-hmm. There's 670,000, I think, was 2024, and then maybe 300, 400,000 in 2025, depending on which ones get built. So you have 1 million units of supply being added to the market, which is going to create disruption for the next 2 years. So now you have that. For the first time in a long time, people are actually having to figure out how to manage.
Right. Their properties.
Yeah, like they never really had to. They were like, oh, rent growths are 5, 6, 7, 8%. Welcome, folks. This is what I started in. I've had turbulent times until the last 10 years. The last 10 years, everybody looked like a star.
So what was interesting about people calling sponsors calling new money last year was that we were told that the rates were going to go down this year. So that was kind of the reasoning behind it.
Yeah.
But as you know, the Fed was supposed to lower rates 6 times this year. They haven't lowered them at all yet. We're in April. And so now they've backed off to 3 times, perhaps at a quarter point
or
each
maybe
time.
not even that. So again, guys, stay big picture. So for all of you that were hanging on 5-6% and you're 5-6 times lowering, and you mailed that or emailed that to all your LPs or whatever you did, you should have stayed big picture, because if you take a look at even the job report that just came out, take a look at that. It's over 300,000 or something like. Well, there's a couple things I want to say about that. The first one is low unemployment numbers are inflationary, period. Fed is very concerned about having low unemployment. They say that stabilizes, the Fed, not me, 4.5. We're at like 3.7 or 3.8. Jerry, is that about right? Okay. So that alone is a couple million people that they're like, uh-oh, this is not good. So, but if you really dig into that data, there's what grew? Full-time did not grow, part-time grew. So part-time unemployment was actually super strong. And why is this important? It's important because some of the Fed chairs are actually looked at that report. This is all, you can read about this. And they're like, I don't know if there's going to be any cuts at all. In fact, there's even a couple that even suggested we might need more rate increases. So this next couple months are going to be really interesting as we start to see some of this inflation, not to mention the fact that we're heading into an election year. So, and I know, the Fed's not supposed to be political, but I can't imagine that they're not going to be. Jerry, can you pull up this chart real quick? I want to show you guys where we are. There's 4 phases in a real estate cycle. So I want you guys to take a look at this. So if phase 1, I would say recovery, that's like 2010 to call it 2014, 15. And that was taking on all the stuff that happened in 07, 08, 09, 10. I went through this period of time. The banks have lots of assets. People lost they far past depression and acceptance. The real estate is now sitting with the banks. Okay. Then we started to see all that get absorbed, and we started to move into phase 2, which was the expansion phase. And the expansion phase was obviously fixing the stuff that we had just gotten from the banks. But then that's when they started lending again, and we started to see new supply being added. And we'll show you that chart in a second. But Jerry, stay on this chart real quick. Okay, so now we hit, I think, the demand-supply equilibrium point, as you guys all know. That all peaked, I would say, more than likely, probably around 22. And even though rents were still going up, don't forget about the lag. The lag kept it going. So with lag, it still continues to push it. And now we tipped, and now we're heading in. We started heading down into 2023. And of course, we're going to slide into 2024 and 2025. And what we're starting to see now on this is commercial real estate, guys. Now, I will talk about residential in a second. But we're starting to see higher vacancy. We're starting to see flattening rents. We're starting to see concessions in the marketplace. We're starting to see higher expenses. And we're starting to see increased vacancies. And what's going to happen is, as you guys know, I use the pig through the python. So these units that started, are under construction. They're making their way through the system. They have to be built. They have to be absorbed. That additional supply helps people. It helps renters, because that means you're not going to have the rent growth and all that kind of stuff. And it's even worse, of course, with a lot of retail, and certainly commercial office is a whole other story. Commercial office is actually worse and further down on this scale. So now let's jump to the single family chart, the Fred chart. And this is really interesting. And I keep telling you guys, this is a supply problem. So I want you to take a look at when we peaked around 2006, 2007, let's just say. Okay. After that, for some of you might remember, some of you are new to this, in 08, 10, 12, 14, you can start to see again, just look at the chart from prior, and you can see we started to recover, let's call it 2012. Okay. So in 2012, the banks are licking their wounds. The lenders are going, that was a rough period of time. It's 3 or 4 or 5 years. Now we're going to start lending again. Things are getting better. But at that point, what I really want you to look at this chart and take a look at is the supply problem. Okay? People were still being born. People were still graduating from school. People were still aging out. People still wanted to move out of their parents' houses. People were still getting jobs. There's a lot of other stuff that's going on during this period of time. So when you do not add supply and it actually does not meet demand, then what happens is you start to see housing prices go up. You start to see rent prices go up. So that's the run we just got. The lag from the lack of supply. If you take a look at multifamily housing, this chart is really not much the same. It's very similar to this. So this is where we are today. Is the completed units, the actual supply itself is what's actually pushing all of this, and then the cheap money. That's a whole nother story, right? So that's now over. And now let's go back to that last chart again, Cherry. If you go back, there you go. So you can see the new construction, what was done peaked in about 2022, and now we're going to head down. So the stuff that was under construction being built, it's now making its way through the system, and that's where we are.
Yes. So to go back to what I was saying. Because the Fed hasn't lowered rates, the new cash is running out, and the reserves it's below the value of the loan.
Yes.
The property's worth below the value of the loan.
So let's focus for a moment on what the interest rates are actually doing to people. Because I think there's a lag and a ripple effect to that. So if you're, let's say, a developer or a contractor, let's use both. A developer is somebody who has a master vision and goes to the bank, gets the debt. Okay. That debt right now is 9-10% construction debt. Okay, so they're like, oh, I'm not going to do that. That's almost double what it was just 2 years ago. Okay, if a developer doesn't build, then a contractor doesn't get the work, the subcontractor, the regular contractor. And of course, they're not hiring people, and so there's a whole bunch of stuff on the supply side. This is the same thing with multifamily, with office, with single family. It doesn't really matter. But the debt reduces potential future supply. That's what I want to tell you. Then you also have the people that got that kind of debt 2 years ago, and during the construction phase, their cost of interest also went up. So there's that problem. Okay, now let's flip to residential. So if you're a residential homeowner and you took advantage of all those refinances, or maybe even it was just a brand new purchase, maybe you sold something and bought another one, you're locked at 3%, 4%. If you're an investor, you're not giving up that loan, right? If you're a homeowner, you're not giving up that loan. So people are staying put, and it's reflecting in the lack of supply with the MLS, right? So you have all these factors happening at the same time. So that's what interest rates do. And then on the consumer side, it's even worse, because the consumers are now sitting, they have 20% on their credit cards. The borrowing cost for a vehicle, or an auto, the auto industry is following a similar path, similar as real estate, because their mortgage payments, their car payments are going up. So all of these higher interest rate costs are killing everybody. And now, as I said to you guys, we are in the hyper supply phase. We're heading toward the recession supply phase as it relates to the 4 stages of a real estate cycle. And we're heading into the bargaining and depression phase of real estate.
So can you explain what that
Sure.
is?
Well, you're already seeing credit card defaults. You're already seeing or car repos. That's way up. We did something on that recently. That's up. People are starting to default on debt. That's actually the bottom line. They're defaulting on debt. And the reason they're defaulting on debt is there's lots of them. But the price of debt has gone up a lot. And they don't have any alternative. So in many, 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 many cases, the property is worth less than the debt. That is actually the scenario. As you guys know, we just did a video last week on YouTube that showed a 100% vacant office building, 117,000 square feet, 100% vacant. I can assure you there was somebody that owned that. I can assure you there was somebody that invested in that. I can assure you that somebody lent against that, and somebody built it, somebody owned it, all of those things. And now it's listed for basically the land cost, and which I don't think is going to even somebody's going to have to rip it down, because they're trying to show it as a conversion, an office building conversion to apartments. That's not happening in that building. And if you want to know why, just take a look at the video. So this stuff is starting to happen. I'm right in the middle of it. As my friend would say, I'm in the catbird seat, because we're starting to see these deals come in. These deals are coming in. They're broken. They're partially leased up. They have high vacancy. Their debt's high. Their expenses are high. And things are not moving like they used to move.
So when it comes to the bank, so if somebody has a loan that it's not cash flowing at the interest rate, and the bank either has to decide to work with them or not work with them, right? And Chris had said on YouTube, he said he believes a lot of banks are going to extend and pretend, which essentially means extend the loan, maybe give them a lower rate, because everyone anticipates that interest rates are going to eventually come down, and we just don't know when, and that will push values up most likely. So when a bank is deciding to work with, do you feel like a lot of banks are going to extend and pretend? Do you think they're going to call the loans?
Chris, great question. So all right, when you hear the word extend and pretend, because we've heard this before, that's a loan modification. Period. Everybody needs to understand it. New contract, new deal. They don't just go, okay, I'll give you another month. That's not how this works. It's a real loan modification. And so they're going to dig in. And what happens during a loan modification? A loan modification, they're going to look at the value of the property, right? Because that's how they're getting paid back. They're like, well, why would I extend a loan where somebody is way below the value of the loan? If somebody is, if the price of the property, like on that office building, is not even worth a third of the loan, then they're probably not going to extend and pretend. If that that property that we showed was 100% vacant, there's no revenue coming in. They're not going to extend and pretend. There are plenty of scenarios where a lender will extend and pretend. And that is if they have somebody with good credit, they have somebody with other sources of income, they have somebody with other collateral, they have tenants in there. In other words, if the only issue they have is perhaps the interest rate and everything else is sound, then very possible they could extend and pretend it's in a form of a loan modification. But they're not going to just bump it out like they did when you first got the loan. They're going to extend it for a little while, and there's going to be conditions, and every single one of those is going to be a little bit different. So the banks are all, mark my words, the banks do not want property, period. They do not want. There's something in the bank rating called net charge-offs. So when a bank's rated, just like you are, imagine like your credit score, and you default on a credit card, or you can't pay a bill, or you don't pay a landlord, that makes its way to your credit score. Same thing with the bank. Net charge-off, same thing. Banks are rated based on their charges as a percentage of their total loans. So if they have $100 million in loans, and there's $10 million of charge-offs, then of course you can figure that out. So you're going to start to see this stuff moving through the pipe, and that's why I say 2024 is the bargaining year, but we're moving into a depression, because the new money, if they raised any in 2023, they did it on the premise that rates were going to actually go down. They're going down 6 times. As you guys know, I never took that position. I said, I don't know. The Fed's inflation rate is still pretty high, and they say they want to get to 2. Now, whether they ever get to 2 or not, and that's debatable. But the point is, they're not even close, and things are going the opposite way. So it's possible that rates are going to be where they are. They could stay neutral. And let's just say, let's argue, for some of you are probably chirping, well, quarter point here, quarter point there. It's not meaningful. It's nothing, actually. It's nothing. They're not going to lower it by 3/4 of a point or half a point. They'll do a quarter just to test it, and then you got a few more months, and then they'll do another quarter. So.
Yeah, Sarah's saying that Wells Fargo just came out and predicted by the end of 2025 rates to be 6.
Yeah.
So that's in about over a year and a half.
Yeah. So okay, that's still not even close to what the economy needs.
Right.
It's just not. And also, let's don't forget, what happens when the rates go down?
Prices go up.
Yeah.
Generally.
Right. It's the opposite of what the Fed wants. So low cost of money creates bubbles. All right. So the interest rates are used to ignite and create things going on in the economy. That's the whole point. They want people to consume. They want people to buy. They want people to refi. They want people to buy houses. They want all of those things. But that also creates a frenzy, and it creates bubbles. And so we still have this, and we're popping right now. So the Fed's almost in a no-win scenario where they have this inflation issue, which many people would say is significantly higher than actually is being reported, and I agree with that. And then they have this unemployment problem, and they have a shelter problem. They're going to have 2 years of relief on the rent, commercial multifamily. That is for sure going to happen. You're going to see flatness in rent. You're going to see some relief for renters. That's going to all be good from a Fed standpoint. You're not going to see it in the single-family home. The single-family homes, there's just simply not enough. We showed you guys the chart. There's simply not enough. MLS is 50% of what historically it's been, and there's not a lot of new construction, because what home builder in their right mind is going to build at 9 or 10%? And they have personal guarantees. They don't even know if they have a buyer, because the buyers have these high interest rates. So it's a slippery slope as we head into November.
So do you think if these banks fail, John had said something about the Dodd-Frank bail-in,
Yep.
where, essentially they use depositors money, give them shares. Is
I
what
hope
he
that
said.
doesn't happen. Yes.
Do you think that it will?
I don't know, man.
Yeah.
Well, I got to tell you guys, I dug down this rabbit hole a few times. It's interesting, like even with Silvergate and Silicon Security, was it Security? I can't remember the other one. No, none of the depositors lost their money. The FDIC stepped in. Even back in 2008 when all the banks were failing, I think there was like 750 banks that actually got consumed and absorbed. You just don't hear about it, right? But if you're, let's say you're in the bank business, you personally, you're probably licking your chops. If you're in really good spot and you have a 1 ranking and you have a lot of liquidity, this might be an opportunity for you as a bank to grow. Okay, so that's how you have to look at it. You just have to put the bank hat on. If I'm a bank, this is what I want. I want to come in. And somebody bought all those assets from those failed institutions. So, I think it was Security they were out of the Northeast. So, Security Pacific. And by the way, they got a loan from the FDIC for 3.5%. I don't know if you really want to dig down that hole. So, this is the time for banks to grow. And it doesn't necessarily mean all bad. I don't think the depositors are going to lose a nickel. And this is really about trading assets and figuring out which ones are toxic.
Some really good comments on YouTube. So Ramai said the Fed is still printing money, and that's the bottom line.
Yep.
Kane said an age-old tale you haven't learned. The Fed doesn't dictate prices. Buyers and sellers, supply demand dictates prices. But the Fed continues to want to continue to control home prices.
Yep.
And something John said, he said rates going down doesn't mean banks want to give loans.
Correct.
And this
Very
will be
good
a big
point.
issue in the
Very
future.
good point.
Yeah,
yes.
exactly.
Good point. I forgot to even mention that. The banks pull back just like you would. If you've got defaulting debt, I saw this in 2008, 9, 10. Like everybody, I don't tell the story very often. But when that was going on and banks were taking back all this stuff, like no banks were lending, no investors were investing. So that's when I went up to Canada and I put together that fund up there. And we started raising money out of Canada. And there's a whole science to that, the whole reason we did it. But for that next few years, we were using Canadian RSP money, retirement savings plan money, just like our 401ks. And that's when we were buying all the stuff in Texas, primarily, multifamily. We still own most of those. And so, yeah, you have to look bigger. That's why you have to think bigger. If you're looking at your little submarket or your state or your city and you're watching little stuff going on, or you're arguing and saying, well, that's not going in I have no new construction. Our rates are fine. Everything's good. All this stuff. Our occupancies in office and retail and multifamily, it's all good. That might be true. But you have to look bigger than that, and you have to take a look at the whole picture because it's super connected, all of it.
Well, and if banks decide not to loan, then that's going to make it harder too.
Right. They've already started to pull back. So with us, we do a lot of agency debt, FHA and Freddie and Fannie, and we're seeing 50-55% loan to value. Which basically means 50% down, or 45% down. So they've pulled back already. And so anything that we're buying today, they're hedging. They're still lending. They want to lend. Banks, think of the point. That is the point, is there are people that, imagine if that all came to a standstill. So it's priced differently. And their exposure, their debt service coverages, and their loan to values have changed.
Absolutely.
Yep.
All right. Well, thank you guys for watching us on a Sunday. We will see you guys next Monday.
Yeah, we'll see you guys. Cheers. Thank you.